bring in Peter Anderson, Chief Investment Officer with Anderson Capital Management, for some gravity and perspective here, and Victoria Greene, Chief Investment Officer with G Squared Private Wealth. Wonderful to have you both along, and just share thoughts on this environment. Victoria, I'll actually start with you. We're seeing people in some ways kind of terrified about what's going on with the two-year yield and what that says about what's coming next. What's your take?
I think the word is panic, Kelly, because that's really where we've gotten with this market. And I think we hit a little bit of oversold, like I talked about, indiscriminate selling. So you had good companies going down with bad. And one of the best examples of that was like Charles Schwab. Why was everybody selling Charles Schwab? They have like $100 billion in liquidity, like on hand, before they even have to sell any of these held to maturity. So anytime you have this panic coming in, people are not thinking rationally, they're thinking emotionally. That's a very dangerous time to be an investor because you aren't seeing rational swings. You're seeing these panic moves up and down. Yeah.
And Peter, there's kind of this urge right now, I think, to say, okay, well, the consumer balance sheet is way different than '06. And, this is not going to rerun exactly like the credit crisis. So therefore, maybe the panic is a buying opportunity, or maybe, we know a downturn's coming, but you can start to kind of pick up stocks on the cheap and look past that. What do you think?
Well, I think the hardest thing has been this past year for investors to take their time and realize that, when the Fed started raising rates a year ago this month, right? In this day and age of instant gratification and social networking, data, et cetera, the Fed still operates in the Stone Age, right? It takes about a year for any of these rate hikes to actually play through the economy. So that's why we are all so anxious looking at every single economic data point that comes out. But in reality, Kelly, I think the SV Bank is really the first hard data point that, ironically, the rate hikes are working, so to speak, because they have caused such havoc. And I think the Fed, in its wisdom, is realizing that they have to slow down because now we're actually seeing some damage, although they might say, positive impacts from the rate hikes. So you put that all together, I am optimistic. I think the Fed would probably have stopped raising anyway in this very close period. The SV just kind of pushes them over the fence earlier. But I do think tech stocks, for instance, have enjoyed a very strong rebound. I mean, I've had a very good year so far to date, kind of dancing between the raindrops of all this stuff. But I do remain optimistic, even in the face of what we are experiencing right now.
Peter, is what happened at SVB, you just said it, evidence that the Fed's rate hiking posture is doing what it was intended to do? It would be very easy to argue, however, that the failure at SVB was because the management didn't do what the management should have been doing, and that is diversifying their deposit base and managing their interest rate risk better. And they had a mismatch of assets, and the Fed may have been, lit the candle, but these guys were the ones who let the fire go.
Oh, absolutely, Tyler. And I guess it's a complicated situation. It's never one main driver, but I think you hit the nail on the head. The fact that the Fed did push the envelope with rate hikes, I think did cause that to come into the forefront where probably it would not have come to surface had the Fed not be so aggressive. So it's very convoluted in terms of who did what. But I do think that we shouldn't panic about this because, as you said, Kelly, it's nowhere near what we went through in 2008. And I do see clear sailing ahead.
Goldman, Schwab, American Express, Victoria, are these for a trade or for the long run?
For the long run, American Express is a phenomenal company. And if you look at how they've managed to increase their savings deposits with their CDs and their savings rates, they're part of the reason people are leaving the bank deposits, since the bank's not paying anything for their checking and savings. I think they're very strong companies. Yes, I know Goldman's going through a little transformation about what they want to do with Marcus and their retail division there. I do have faith Goldman will find their ways. They're quality companies. And if you look at their diversified balance sheets, how they're making money, where their revenues come from, I think they're going to weather any challenges to this financial sector much different than, say, just a traditional standalone bank. But they're not just trades for me. They're good, strong companies. I wouldn't buy them if I didn't believe in them.